Hi there, tax accountants. I hope all is well, and I pray that as you are viewing this video, that you're in the best of health and spirit. This video will cover Chapter 3, which covers the taxation of corporations and the comparisons of how individual taxation differentiates from corporations. We'll also get to learn the different tax rules that are unique to corporations. We'll also have the opportunity to calculate the corporate income tax. And then we'll also discuss, describe, and illustrate the reporting process for corporations. So we'll look at a few questions from Chapter 3. So this problem here asks to indicate whether the following statements are true or false regarding the computation of income tax for C corporations. All right, so here it's asking about A, which states C corporations do not have to file a federal income tax return unless it has taxable income. So this is actually false. A C corporation, they have to file a federal income tax return whether or not they have taxable income. So even if the corporation has no income, no expenses, per the federal tax law, a corporation is required to file a federal income tax return. If a corporation began or they stopped operations during the year, in such case, they would file what's called a short period return, which is a return for less than 12 months. But this first option is false. Next, it asks, for calendar year C corporations, the corporate tax return is due March 15th of each year. So just to ensure that you understand the difference, a calendar year is from January 1st to December 31st, and a fiscal year is any other 12-month period. So to make it easier, think of it from birthday to birthday. With each birthday that passes, that's a 12-month period other than a calendar year. So again, calendar year, January 1st to December 31st. A fiscal year is any other 12-month period. So to gain a better understanding of what a fiscal year is, think of it from birthday to birthday. So for calendar year C corporations, the corporate tax return is due March 15th of each year. A Form 1120 must be filed on or before the 15th day of the fourth month. So much like an individual, a C corporation has the same deadline, which is April 15th. March 15th is for S corporations and partnerships. All right, so just keep that in mind. S corporations and partnerships, they must file their business returns by March 15th. And for C corporations, much like individuals, they need to file a tax return by April 15th. So much like an individual, corporations, they can receive an automatic extension of 6 months if they file Form 7004, by the due date. All right, but just keep in mind, just because they file an extension does not mean that it will be accepted. The IRS may decide to terminate an extension by mailing a 10-day notice to the taxpayer corporation. So just keep that in mind. Extension can be applied for, but it's not guaranteed because the IRS might just decide to deny it. C asks, C corporations must make payments of estimated tax unless its tax liability can reasonably be expected to be less than $500. So this is actually true. So in addition, the payments must equal the lesser of 100% of the corporation's final tax or 100% of last year's tax. So this is essentially similar to individuals who need to pay estimated taxes. So these payments, they will be made in 4 installments due on or before the 15th day of the 4th, 6th, 9th, and 12th months of the corporate taxable year. So that's April 15th, June 15th, September 15th, and December 15th of the corporate taxable year. And the full amount of the unpaid tax is due on the date of the return. So if there's a failure to make the required estimated tax pre-maintenance, then it requires a non-deductible penalty that's imposed on a corporation. So as it relates to these estimated tax payments, it's fairly similar to the penalty assessment for an individual. Lastly, Schedule M3 is required of corporations with more than $10 million of total assets. So whenever corporate taxpayers have total assets of $10 million or more, they are required to report much greater detail relative to any differences between income loss that's reported for financial purposes versus reported for tax purposes. So there's basically an expanded reconciliation of book and taxable income that's reported on this Schedule M3. So one of the goals of the Schedule M3 is basically to help create greater transparency between the corporate's financial statements, which is governed by GAAP, generally accepted accounting principles, especially if it is a public company, and the tax returns. Schedule M1, on the other hand, that's required of corporations that have less than 10 million of total assets. So again, M1 and M3 are essentially the same, but it depends on the total value of the assets for the corporation. If it is less than 10 million, Schedule M1 is filed. If it is more than 10 million, Schedule M3 is filed, which goes into greater detail to reconcile book and taxable income. So C is true and D is also true. This next problem asks us about M2. So Schedule M2, we just discussed Schedule M1 and M3. Schedule M2, on the other hand, this schedule reconciles any unappropriated retained earnings at the beginning of the year with any unappropriated retained earnings at the end of the year. So in order to calculate this, it's the beginning balance plus the net income per books as it's entered and reported on line 1 of Schedule M1. Then from there, we subtract any dividend distributions during the year, and that essentially equals the unappropriated retained earnings. So there might be some other sources of increases or decreases in retained earnings that's also listed on Schedule M2. So whenever there's a corporation that has less than $250,000 of gross receipts and less than $250 in assets, they don't need to complete Schedule L. And Schedule L is basically the equivalent to a balance sheet. And in addition, they don't need to complete Schedule M1 and M2 of Form M 1120. And the same rules basically apply for 1120S. So the main purpose is because if it's a really small corporation, it would be a bit of a nuance. It would be inundating to require a small corporation to have to report these forms. So that's why they essentially have these thresholds. So if the corporation has less than 250,000 of gross receipts, less than 250 in assets, they don't need to complete Schedule M, M1, or M2 of Form 1120. So complete the following statements regarding the Schedule M2. Schedule M2 is mentioned reconciles unappropriated retained earnings at the beginning of the year with unappropriated retained earnings at the end of the year. How is the calculation done? It is the beginning balance plus net income per books as it is entered on Schedule M1. And from there, we subtract not cash, not net income, but we subtract the dividend distributions during the year. And that essentially equals the ending unappropriated retained earnings. So again, for those of you who do desire to venture into taxation, you may or you may not see some of these schedules because, again, of the thresholds, the limitations. But for the most part, there are some small businesses that still want to, prepare and complete these forms essentially. But for the most part, again, be aware of the thresholds because you could just, save yourself. Again, the rules and limitations, they're intended to ease the compliance burden on smaller businesses. Now this asks us about the M3. So now it asks to indicate whether the following statements are true or false regarding Schedule M3. So any corporation that files Schedule M3 must also file Schedule M1. So this is false. As mentioned previously, corporations that are not required to file Schedule M3, they may decide to do so voluntarily. All right, but any corporation that files Schedule M3 is not allowed to file a Schedule M1. So as we mentioned, Schedule M1 and M3, they both essentially serve the same purpose. The key thing is that you want to be able to reconcile the book income, the income reported on the financial statements versus the income that is reported on the tax return. So there's some differences. Sometimes there's a temporary difference, sometimes there's a permanent difference. The key thing within M1, this is for corporations that have assets that are less than 10 million. And for corporations that have assets that are more than 10 million, they need to complete Schedule M3, which is similar to M1. However, there's greater detail required when Schedule M3 is prepared. So B states, one objective of Schedule M3 is to create greater transparency between corporate financial statements and tax returns. This is true. So as just discussed, Schedule M3 is basically, a response in part to a lot of the financial reporting scandals that took place. So there was Enron, there was WorldCom, there was a lot of fraud that took place. And unfortunately, they had the Sarbanes-Oxley Act, and there were a lot of things that were put in place to hopefully prevent or deter these types of, massive frauds in the financial world from taking place again. So one objective of Schedule M3, yes, it is to create greater transparency between corporate financial statements and tax returns. And another objective is essentially to identify any corporations that engage in, aggressive tax practices by requiring that transactions create these book to tax differences. With this M3, they are going to be disclosed on a corporate tax return. C states, corporate taxpayers with total assets of 10 million or more are required to report much greater detail relative to differences between income loss reported for financial purposes and income loss reported for tax purposes. The answer is true. Again, that is the purpose of the M1 in comparison to Schedule M3. So this brings us to our next question. So it asks, how much is Jay's income tax liability for the year? So it says, during the current year, J Corporation, a calendar year personal service C Corporation, had operating income of $300,000, operating expenses of $200,000, a short-term capital gain of $5,000, and a long-term capital loss of $35,000. How much is Jay's income tax liability for the year? So the first thing is we need to calculate the taxable income. So based on the information, we have $300,000 of operating income. We have $200,000 of operating expenses. It also says that we have a $5,000 short-term capital gain. And that although we have a $35,000 capital loss, only $5,000 is essentially deductible. Why? Because for corporations, capital losses are deductible only to the extent of the capital gains, and any capital losses that are not accounted for in the current year due to this limitation, they're carried back 3 years and carried forward 5 years as short-term capital losses. All right. So again, that's one thing to keep in mind. For corporations, capital losses are deductible only to the extent of capital gain. So therefore, of the $35,000 capital loss, only $5,000 is deductible. So therefore, the taxable income for J is $100,000. So with the Tax Cuts and Jobs Act, corporate tax rates are no longer progressive like individual taxation. Instead, there's a flat 21% tax rate. So all C corporations, including PSCs, personal service corporations, are taxed at a flat rate of 21%. So the taxable income of 100,000 multiplied by 21%, the total tax is 21,000. So again, quickly, just so you see how the taxable income was calculated, it is the $300,000 of operating income minus the $200,000 of operating expenses. We add the short-term capital gain of 5,000. And as mentioned, even though there's a long-term capital loss of 35,000, for corporations, capital losses are deductible only to the extent of capital gain. So therefore, we can only deduct a $5,000 loss. And that is how we calculated $100,000 of taxable income. We multiply it by the flat tax rate of 21%. So therefore, the income tax liability for the year is $21,000. Here it asks us to watch a quick lesson for income taxation video and answer the questions below, but we'll look at the question. So it states, corporations and individuals compute gross income similarly. So this is true, right? So even though there are some differences between corporate and individuals, there are a lot of similarities that need to be accounted for, right? So some similarities, the gross income of a corporation and individual, it includes compensation for services rendered, business income, gains from selling property. It's essentially similar. Any non-taxable exchange treatment is considered similar. Any gains and losses from property transactions are handled similar. Deductions of a corporation and an individual are also similar. There are obviously some key differences because with the Tax Cuts and Jobs Act, corporate tax rates are no longer progressive. But again, for the most part, corporations and individuals compute gross income similarly. 2 states business deductions are only allowed for corporations. This is false, right? So business deductions are allowed for both businesses and, individuals rather, and corporations, right? As provided that if we refer to what's called Section 162, business deductions are allowed if they are necessary and reasonable, right? So business deductions, they're basically deducted from gross income to determine whether there's taxable income and if there's, this is obviously prior to any NOLs, any net operating losses. So when we get a bit more into calculating the special taxable income for corporations, we'll learn a bit more about what's called dividends received deductions. But 2 is false. Both business deductions are allowed for individuals and corporations. All right, so here we have this question, and it asks us, what is the amount of Delta Co's taxable income for the current year? So it says Delta Company, an accrual-based calendar year C corporation, had the following revenue and expenses on its current year financial income statement. Then it also lets us know that there's some tax depreciation used in makers. The actual write-offs of uncollectible accounts for the year were $15,000. What is the amount of Delta Company's taxable income for the current year? So in order for us to determine the taxable income for the year, there's some things that we need to consider. So again, this represents the financial income statement, but we need to determine the amount per Schedule M1. So again, that's the purpose of the M1. The M1 is to help reconcile the differences between the financial statement income and the tax return income. So to determine such, we are going to quickly look at a spreadsheet. All right. So in order for us to calculate all right, so we're going to make this a little smaller. All right, so we start off with the net income per books. And we see that based on this information, It says the net income after taxes is $235,000. So we start off with the 235,000. Sorry, we're going to get this together. All right, so we start off with the 235,000, which represents the net income per books. And from there, we need to account for the federal income tax. So here we see the federal income taxes. We add that back. The federal income taxes were 65,000. And then from there, we need to add expenses that are recorded on the books this year and not on the tax return. So some things that we need to account for are the payroll tax penalties of $10,000. There's some book depreciation that was recorded, and we see here the book depreciation of 40,000. And then we also need to account for the bad debt expense under the allowance method of 20,000. All right, and we add these together for a sum total 70,000. And then the next step, we need to account for the deductions on the tax return this year that's not reported in the financial statement. So if we look at this information here, it says Delta Company's tax depreciation uses makers is $75,000. So this is the tax depreciation, again, that's reported on the tax return, but not on the books. So the tax depreciation is 75,000. And then it also lets us know that the actual write-offs of uncollectible accounts for the current year were 15,000. So we also account for that. So we get the sum total of our deductions, which is 90,000. So in order to calculate the taxable income, we calculate it as follows. So we'll essentially get the sum for each. All right. So we essentially account for the net income per books, which is the 235,000 plus 65,000. We add the expenses recorded on the books this year or not on the tax return. And then from there, we account for the $90,000 that needs to be subtracted. And this gives us net income, or taxable income rather, of $280,000. So again, Delta's current year taxable is $280,000. The payroll tax penalties and the federal income taxes are non-deductible for tax purposes. Keep that in mind. The maker's tax depreciation, we deduct it on the income tax return because it's deducted on the income tax return rather than the book depreciation expense that's included on the financial income statement. In addition, the actual write-offs of uncollectible accounts in the current year are deducted on the income tax return rather than the bad debt expense using the allowance method. So we see there's differences between the $15,000 and the $20,000 that's under the allowance method that's governed by GAAP, right? So this, what we just created, is basically an example of the Schedule M1, which reflects the book to tax reconciliation. So again, we start off with net income per books. We add the federal income tax, and then from there, we add any expenses recorded on the books this year and not on the tax return. And then we subtract any deductions that are on the tax return this year, but not reported on the books. So the correct answer is $280,000. So this brings us to our next question. And it says, what is the maximum dividends received deduction available to parent? So this question is asking us about dividends received deduction. So one of the challenges with being a corporation is that, the corporation, much like individuals, they pay a flat tax rate of 21%. And the issue is that when they distribute dividends to the shareholders would report the dividend income on their individual tax return. And then let's just say that a corporation is paying dividends to another corporation. That is one of the challenges. So there's a level of double taxation. And when corporations issue dividends to another corporation, there might be a layer of triple taxation. To avoid that, we have dividends received deduction. So when it comes to dividends received deduction, it's very important to understand the rules behind what determines how much can be deducted. So, as it relates to the dividends received deduction, it is ultimately dependent on the ownership. So, to ensure that you have a greater understanding of how this works, we look at this here. The purpose of dividends received deduction is to mitigate multiple taxation of corporate income. Without this deduction, income paid to a corporation in the form of a dividend would be taxed to the recipient corporation with no corresponding deduction to the distributing corporation. Later, when the corporation paid the income to its shareholders, the income is again subject to taxation, right? So, again, this is one of the purposes of the dividends received deduction. The amount of the dividends received deduction is mentioned. It depends on a percentage of ownership, which entails the voting power and the value that the recipient corporate shareholder holds in the domestic corporate that's making the dividend distribution. The dividends received is limited to a percentage of the taxable income of a corporation. So for this purpose rather, taxable income is computed without regard to the annual deduction. So the dividends received deduction and any capital loss carried back to the current year. So this is essentially how we determine how much is deductible. If the recipient corporation owns less than 20%, the deduction for dividends received is 50%. If they own more than 20%, but less than 80%, the dividends received deduction is 65%. And if they own 80% or more of that corporation, the deduction is 100%. So keep that in mind. So as we look at this problem, we see that the percentage, it says parent corporation owns 15% of sub corporation. Parent has gross income of $43,000 and allowable deductions of $40,000 before considering any dividends received deduction. Included in the $43,000 of gross income is $8,000 in dividends from sub. So based on a small percentage of ownership, as we just discussed, because it's less than 20%, the applicable dividends received deduction rate is 50%. So the total dividends, as we see, is $8,000 and 50% of that is $4,000. So just keep in mind, there is generally a limitation. And the limitation, as we see here, the steps, we multiply the dividends received by the deduction percentage. From there, we multiply the taxable income by the deduction percentage. And the deduction is limited to the lesser of step 1 or step 2, unless deducting the dividends received deduction results in a net operating loss, which we'll look at a little later. So in this case, we see here that the taxable income before dividends received deduction is $3,000. So how do we determine that? So we see here they have gross income of $43,000, and then they have deductions of $40,000. So therefore, the limitation does not apply, and we get to take the full $4,000 deduction because it would create a net operating loss. Let's say that the gross income was $50,000 and we had deductions of $40,000. In such case, if we were to take the dividends received deduction, we would still have a positive net income. So therefore, in that case, we essentially would not take the dividends received deduction of the full amount because, again, we take the lesser of the two. So in that example, again, the key thing is when we take the dividends received deduction, if it creates a net operating loss, then the income limitation does not apply. So therefore, in this case, because claiming the dividends received deduction will create a loss, we take the full amount. So again, 43,000 minus 40,000 gives us taxable income before dividends received deduction of 3,000. We multiply this by 50%. All right, that would be 1,500. But again, because the taxable income is 3,000, and if we take the 50% of our dividends, which is 8,000, multiply by 50%, because it creates this net operating loss, we take the full amount. All right, here we have our next question, and it asks, what was Karas Corporation's taxable income for the current year? So it says, before the provision for federal income tax, Karas Corporation had book income of $400,000 for the current year. The book income includes $100,000 of dividends received from a 15% owned domestic corporation. What was Karas Corporation taxable income for the current year? All right. So we'll look at this here. We know the book income before federal income taxes, it lets us know here, is 400,000. And then from there, we need to account for the dividends received deduction. So we need to first determine whether or not Karas Corporation qualifies to report a dividends received deduction of 50% of the dividends from the taxable unaffiliated domestic corporation. So 50% of the dividends is allowed as a dividends received deduction if the ownership of the corporation that paid the dividend is less than 20%. So in this case, we see that the ownership is 15%. So therefore, we need to determine how much are they allowed to take. So the book income includes $100,000 of dividends received from this 15% owned domestic corporation. So therefore, the dividends received deduction in this case is $100,000 multiplied by the dividends received deduction percentage, which is 50%. So we multiply it by 50%. So therefore, the dividends received deduction is 50,000. So the taxable income in this case is the book net income minus the dividends received deduction of 50,000. And again, as we pointed out with the rule earlier, it is generally always limited to the taxable income before the special dividends received deduction. And then from there, we would take the lesser of the two. And in this case, $100,000 is less than the $400,000. So here we have the taxable income of $350,000. This brings us to our next question. What amount should be reported as income before special deductions? In the current year, Acorn Inc. had the following items of income and expense. We have sales of $500,000, cost of sales of $250,000, and dividends received of $25,000. The dividends were received from a corporation of which Acorn owns 30%. So we know that whenever a corporation owns between 20 to 80%, the dividends received deduction is increased by 15%. So instead of 50%, it is now 65% that is allowed to be deducted. So in Acorn's current year corporate income tax return, what amount should be reported as income before special deductions? So income before special deductions is very important when it comes to determining the dividends received deduction. So income before special deductions includes sales, dividends received, and cost of sale, and it excludes the dividends received deduction, which is a special deduction. So in order for us to calculate it, we need to do the following. So we start off with our sales of $500,000. And then from there, we account for the cost of sales. So when we account for the cost of sales, this gives us a gross profit of $250,000. And then we also need to account for the dividends received, which is considered income. So therefore, in order to determine our income before special deductions, it is our gross profit plus the dividends that have been received of $25,000. So therefore, the income before special deductions is $275,000. All right. So this brings us to our next question. And this is pertaining to the Schedule M1. It's asking us which of these are essentially added or deducted on the Schedule M1 schedule. So again, the purpose of the Schedule M1 is essentially to reconcile the differences, the permanent and the temporary differences between the financial statement, the book income, and the income that is reported on the tax return. So here it states Emerald Corporation, a calendar year and accrual method taxpayer, provides the following information and asks you to prepare Schedule M1 for 2024. We have net income per books after tax, federal income tax per books, tax exempt interest income, life insurance proceeds received as a result of death of corporate president, interest on loan to purchase tax exempt bonds, excess of capital losses over capital gains, premiums paid on life insurance policy on the life of Emerald's president. So it's asking classify each item as being added or deducted. So as it relates to the federal income taxes per books, these are added back. So if a company takes an expense for federal income taxes in their book income, this is going to be added back as federal income taxes are not an allowable expense when computing taxable income for tax purposes. Next, we have tax exempt interest income. So on the books, the financial statements, we're going to report it as income. However, for tax purposes, because it is tax exempt interest income, it is deducted. Next, we have life insurance proceeds that are received as a result of death of a corporate president. So even though the life insurance proceeds are reported as income on the financial statements, life insurance proceeds, much like for individuals, are not taxable to a corporation. So therefore, because it's not included in taxable income, we deduct it. Next, we have interest on loan to purchase tax exempt bonds. So any interest on loan to purchase a tax exempt bond, they're deducted for financial accounting purposes, but for income tax purposes, it is not considered deductible, right? And the reason being, if we think of it logically, the tax exempt bonds are not reported as income. So, based on the IRS's logic, why would we allow a deduction for income that is not taxable? So, therefore, interest on loans to purchase tax exempt bonds would be added back because it is not allowed as a deduction for tax purposes. Next, we have excess of capital losses over capital gains. These would essentially be added back as well. So the excess of capital losses over capital gains, it is allowed to be deducted for financial accounting purposes, but it's not deductible by the corporation for income tax purposes. So therefore, it's going to be added back to book income. So as we discussed a bit earlier, the capital losses are only allowed to be deducted to the extent of the capital gains. And again, that is how capital losses are treated for tax purposes. For book purposes, however, you get to claim the full amount of losses in the financial statements, but for tax purposes, that is now allowed. So therefore, it is added back. Lastly, we have premiums paid on a life insurance policy on the life of Emerald's president. So again, much like if we think about the interest on loan to purchase tax exempt bonds, it is not included in income. So therefore, you are not allowed to claim a deduction for the interest expense. So in this case, because the premium or the policy rather is not included in income for the corporation when they receive the life insurance proceeds. So therefore, the premiums paid, although it is an expense for the financial statements, it is not an expense for tax purposes. Therefore, it is added back. So for B, it asks us, what is the net income per books that is reconciled to taxable income? So how would we determine that? So we get our spreadsheet. And we need to calculate the amounts. All right. So the key thing is we need to start off with our net income per book. So our net income per books in this case is $268,200. And from there, we need to add back our federal income taxes per book. So here it shows our federal income taxes per book of $31,500. So I'm actually going to take a screenshot of this so that way we can essentially put them side to side so we don't have to keep going back and forth. So I'll take a screenshot. We'll bring this down, make it a bit more visible. All right, so we'll start to scroll down. We'll just shift this a bit. All right, so here we see the excess of capital loss over capital gains. And we see the amount here of $6,000. It's already calculated for us. So that's $6,000. And then the next step, it's asking us, is there any income subject to tax not recorded on the books this year? The problem doesn't let us know that. So therefore, box 4 is a 0. So we scroll down and line 5 asks us about any expenses recorded on the books this year not deducted on the tax return. So this is the interest on loan and the life insurance premium. So therefore, we consider the interest on a loan to purchase the tax exempt bonds because again, it is reported for financial statement purposes, but because it is not included in taxable income, we add it back to income. So therefore, we have $1,500 for interest on loan to purchase tax exempt bonds. Then we have premiums paid on life insurance policies. So we add the two, $1,500 plus $7,800. That should give us $9,300. So $1,500 plus $7,800. Again, so we have $9,300. All right. And then for line 6, it asks us to add lines 1 through 5. So we start off with the net income per books. From there, we add back the federal income taxes per books because it's not deductible for tax purposes. We add back the excess of capital losses over capital gains because per the tax laws, corporations can only deduct capital losses to the extent of capital gains. And then we also add back the interest on the loan in addition to the life insurance proceeds because again, if it is not considered taxable for income purposes, for tax income purposes, you are not allowed to claim a deduction. So $315,000. Then now we move on to the next side. And then box 7 asks us to account for any income that's recorded on the books this year, not included on the tax return. So we have tax exempt interest, as we see, of $15,000. And then the next thing that we account for are the life insurance proceeds of $150,000. So we account for the life insurance proceeds. And then we see here there's a life insurance proceeds less the premium. No, we subtract the entire amount of the life insurance proceeds because again, it's not taxable. So we account for the two, which represents the $15,000 plus the life insurance proceeds. We add the two, that gives us $165,000. And then we look at line 9, we add lines 7, which is $165,000. Line 8, there's nothing to account for. So therefore, line 9 is $165,000. And then now, in order for us to determine the income, we subtract line 6 less line 9. So we get our calculator, and it's 315,000 minus our 165,000. So therefore, we were able to reconcile the difference between the book income and the tax income on the Schedule M1. So again, generally, for the most part, you use the tax software, and the tax software will, account for this information as it is reported. But the key thing is you want to be able to understand the nuance, the basics, behind the purpose of this schedule, in addition to what needs to be added back and what needs to be deducted. All right, so this brings us to this next question. And it asks us, what are gross corporations' minimum required estimated tax payments for 2025? So just to get a better understanding, to ensure, again, you understand how estimated taxes work. So a corporation must make payments of estimated taxes unless its tax liability can be reasonably expected to be less than $100. So the required annual payment is the lesser of 100% of the corporation's tax for the current year, or 100% of the tax for the preceding year, which is the prior year, if it was a 12-month tax year and the return filed showed a tax liability. So as mentioned earlier, estimated payments can be made in 4 installments due on or before the 15th day of the 4th month, 6th month, 9th month, and the 12th month of the corporate tax year. The full amount of the unpaid tax is due on the date of the tax return, which is April 15th. Unless, of course, there's a holiday or the date falls on a weekend, then it's the following Monday. But again, for the most part, corporation due date is the same as individuals, April 15th. So a large corporation may use the prior year's tax liability exception only for purposes of its first estimated payment. So any shortfall from not using the current year's tax liability for the first installment must be paid in conjunction with the second installment. So you might be saying, what does that even mean? So we'll look at the problem. All right, so here it says, Grouse Corporation, the calendar year C Corporation had taxable income of 1.4 million, 1.2 million, and $700,000 for 2022, 2023, and 2024, respectively. Grouse has taxable income of $1,600,000 for 2025. What are Grouse Corporation's minimum required estimated tax payments for 2025? All right. So in order for us to determine the amount, we first factor in what is the preceding year's tax. So for 2024, we see that the taxable income was $700,000, right? How do we know that? Because that's what the problem lets us know. $1,400 was the taxable income for 2022, 1.2 million taxable income for 2023, and 700,000 is the taxable income for 2024. So therefore, we account for the preceding year's tax liability. So 700,000 multiplied by 21%, the tax liability would be 147,000. So we know that there are 4 periods. So therefore, in order to determine the preceding year's tax for the first installment only, it would be 147,000 divided by 4. All right. So just to make sure that you understand how this amount was calculated, it's the $700,000. Now just add the verbiage above so you understand where it's coming from. So it is the taxable income multiplied by the tax rate of 21% equals the tax liability. All right, so $700,000, the tax rate is 21%, and that would give us our tax liability. So that's step 1, $700,000 multiplied by 21%. The tax liability is $147,000 rather. So then from there, we want to determine what the first installment should be. So therefore, the prior year tax liability of 147,000, we divide it by 4 because again, there's 4 installment payments. So therefore, the minimum required estimated tax payment for the first quarter should be $36,750. Again, so this is based on a preceding year's tax. So now we essentially need to determine the remaining installments for the current year. So in order to do such, we see that there's taxable income of 1.6 million for 2025. So therefore, same thing, taxable income of 1.6 million multiplied by the tax rate of 21%, the tax liability is 336,000. All right, so therefore, 336,000, we divide it by 4 quarterly payments. So therefore, each quarter we need to pay $84,000. But the second installment needs to include any shortfall from the first installment. So for the first installment, we only paid $36,750 based on the preceding year's tax liability. So let me say divided by, the thing is you can't input a divided sign. So divided by 4 installments. Just so you understand how we calculated this amount. So again, we divided by 4 installments. And that is how we calculate this amount. All right, so again, we need to account. We know that for December 15th, it is going to be 84,000. And then for September 15th, 84,000. But now for the second quarter, we need to account for the 84,000, and then we also need to account for the shortfall. So the shortfall for the second period would essentially be the 84,000 minus the 36,750. So we need to account for the second quarter payment plus the shortfall from what we did not pay in the first quarter. So therefore, in the second quarter, we are paying the 84,000 plus the shortfall from the payment for the second quarter. So therefore, our second quarter payment will total $131,250. So again, for the first quarter, we used the preceding year's tax, which the problem let us know for 2024, taxable income was 700,000. Corporations have a flat tax rate of 21%. So 700,000 multiplied by 21 equals 147,000. We divided it by 4 installments. So that is why for April 15th, the first installment is 36,750. Now for the remaining installments, it's based on the current year's taxable income. Gross has taxable income of 1.6 million. So we multiply the 1.6 million by 21%. That gives us a tax liability of 336,000. So from there, we divide it by the 4 installments of 84,000. So for the fourth quarter and the third quarter, we know we're paying 84,000, but for the second quarter, we need to account for the 84,000, but then we also need to account for the shortfall, the amount that we did not pay in the first quarter, because again, we used the prior year's tax liability. So what we simply did, we subtracted the required quarterly estimated payment minus the estimated payment we made for the first quarter. That gave us a difference of 47,250. So we added the quarterly payment of 84,000 with the shortfall from the first quarter, and that gave us a total estimated payment for the second quarter of 131,250. So we calculate the total 36,750 from the first quarter, 131,250 from the second quarter, 84,000 from the third quarter, and 84,000 from the fourth quarter, for a total of $336,000 of estimated taxes. So again, one of the great thing is that generally the tax software will automatically calculate the estimated taxes for you. But the reason why this is important is because when you venture into tax projections and tax plannings, you'll be able to, work with the client to be able to explain to them how much they need to pay and why based on the rules. All right, so this brings us to our next question, and it asks, assume that all corporations use a calendar year for tax purposes and that the year involved is 2024. And it says, in each of the following independent situations, determine the corporation's income tax liability. So in all of these cases, we see purple corporation, azul corporation, pink corporation, turquoise corporation, and teal corporation, which is a personal service corporation. So a personal service corporation, also referred to as a PSC, is basically a corporation that's substantially employee owned, right? And then it engages in one of the following activities. Maybe it's health, it's law, architecture, accounting, right? But much like any other corporation, personal service corporations are also taxed at 21%. So for each of these corporations, we're taxing it at 21%. So 65,000 multiplied by 21% is 13,650. For Azul Corporation, their taxable income of 290,000 multiplied by 20% is 60,900. For Pink Corporation, their taxable income is 12,350,000 multiplied by 21%. Their tax liability is 2,593,500. So 2,593,500. For Turquoise Corporation, their taxable income is 19 million. So we multiply the 19 million of taxable income by 21%. Their tax liability is 3,990,000. For Teal Corporation, a personal service corporation, again, is still subjected to a flat 21%, so 130,000 multiplied by 21%. The income tax liability is 27,300. So again, corporate tax rates, they've fluctuated over the year. The top corporate income tax rate was reduced from 46% to 34% in 1986. And then it was raised to a top rate of 35% a few years later, right? So this rate was the highest, but with Tax Cuts and Jobs Act, which was enacted in 2017, the Tax Cuts and Jobs Act reduced the corporate tax rate to a flat 21%. All right, this brings us to our next question. And here it's asking us, in each of the following independent situations, determine the dividends received deduction for a calendar year C corporation. Assume that none of the corporate shareholders own 20% or more of the stock in the corporations paying the dividends. All right, so we'll get our spreadsheet ready and we'll start to look at this problem. So to make it easier, I'll copy over the information and we'll just look at it through the spreadsheet. All right, so here we go. So we have Almond Corporation. Then we have Berry, or Banana rather. And we have Cherry. All right, so in these examples, and I'll just highlight it so we know where we're getting the information from. So we discussed the dividends received deduction a little earlier. And as mentioned, the purpose of the dividends received deduction is basically to help mitigate multiple taxation of corporate income. So without the deduction, any income that's being paid to the corporation in the form of the dividend, the challenge is, first and foremost, is tax to the corporation. They're not allowed to take a deduction, right? And then when the corporation pays it to shareholders, the income is then again reported on their tax return. They'll receive a Form 1099 DIV, and then it's subject to taxation, and there's no corresponding deduction. So again, that is one of the purposes of the dividends received deduction. So the amount of the dividends received deduction, it ultimately depends. This is the determining factor. what is the percentage of ownership? So depending on the percentage of ownership, that ultimately determines the deductible amount. However, there is a limitation. So for this purpose, the dividends received deduction is limited to a percentage of the taxable income of a corporation. So for this purpose, the taxable income is computed without any regard to annual deduction, the dividends received deduction, or any capital loss carried back to the current year. So the percentage of the taxable income limitation corresponds to whatever the deduction percentage is. So again, here's the steps. We multiply the dividends received by the deduction percentage. Step 2, we multiply the taxable income by the deduction percentage. And then for step 3, the deduction is limited to the lesser of step 1 or step 2, unless deducting the amount arrived in step 1 results in a net operating loss. And in such case, then the full amount of the dividends received deduction is allowed. All right. So here we look at this example. And it lets us know for Almond Corporation, they received dividends of $100,000. And let me pull it back up. All right. And it lets us know here that assume that none of the corporate shareholders owns 20% or more. So all of them are less than 20% owned. So this is what we are going to be factoring in, right? The 50% percentage. So based on this information, we start to look at everything that's taken place. So for step 1, we factor in the dividends received. So all of them received the same amount of dividends. They all received $100,000. So for Almond Corporation, $100,000 multiplied by 50%. For Banana Corporation, 100,000 multiplied by 50%. For Cherry Corporation, $100,000 of dividends multiplied by 50%. So we just completed step 1. We multiplied the dividends received by the deduction percentage, which is 50%, because each corporation, Almond, Banana, and Cherry, owned less than 20%. So now for step 2, we need to factor in the taxable income before the dividends received deduction. So how do we figure out the taxable income? So here we have taxable income of $200,000. How do we calculate that amount? It was calculated as follows. So $700,000 minus $600,000 plus the $100,000 of dividends received deduction, right? Or the dividends received rather, because again, the qualifying dividends received is considered income. We do the same thing for Banana. There's income of $800,000. We minus the expenses from operations of $860,000, and we add the $100,000 of income for dividends received. That gives us taxable income before dividends received of $40,000. We do the same thing for Cherry. $900,000 of income. We subtract the expenses from operations. And then from there, we add the qualifying dividends received. So therefore, there's $90,000 of taxable income before the dividends received deduction. So now we move on to the next step. 200,000 multiplied by the applicable percentage gives us 100,000. For Banana Corporation, the taxable income before dividends received deduction multiplied by 50%, which gives us 20,000. And for Cherry Corporation, 90,000 multiplied by the applicable percentage, which gives us 45,000. So step 3 lets us know the deduction is limited to the lesser of step 1 or step 2. Again, unless deducting the amount derived in step 1 results in a net operating loss. So as we look at this example, we look at the lesser of the two, 50,000 minus 100,000, right? So We know that if we were to subtract 50,000 from 200,000, that would not create a loss. The taxable income instead would be 150,000. So therefore, we claim the 50,000, right? For Banana Corporation, there's taxable income of $40,000. And if we were to claim the $50,000 dividends received deduction, this would create a net operating loss of $10,000. So because of that, it generates a net operating loss. So therefore, we claim the full $50,000. Again, for Banana Corporation, the taxable income before dividends received deduction is $40,000. $800,000 of income minus $860,000 of expenses from operations plus $100,000 of qualifying dividend gives us $40,000 of taxable income before special deduction. So again, the limitation is unless deducting the amount derived in step 1 results in an NOL, we take the full amount. So $40,000 in income minus $50,000 in dividends received deduction would give us a $10,000 loss. So therefore, we claim the full dividends received deduction. For Cherry Corporation, the taxable income is $90,000. If we subtract $50,000 from $90,000, we would still have $40,000 of taxable income. So therefore, the limitation does not apply, or the limitation of the net operating loss does not apply to the situation. So therefore, we take the lesser of the two, which in this case is 45,000. And again, when you're using the tax software calculates this stuff, but it is very important to be able to understand the nuance. So again, we start off by multiplying the dividends received by the deduction percentage. For less than 20% ownership is 50%, 20% or more, but less than 80, it's 65%, and 80% or more, it is 100%. For step 2, we multiply the taxable income by the deduction percentage. And for step 3, we take the lesser of step 1 or step 2, unless deducting the amount derived in step 1 results in a net operating loss. All right. So this brings us to our next question. So here it says, Swallow Corporation owns 12% of Brown Corporation stock. How much is Swallow's taxable income or net operating loss for the year? Assume instead that Swallow Corporation owns 26% of Brown Corporation stock. How much is Swallow's taxable income or net operating loss? All right. So as mentioned, we always need to factor in. We just saw the steps. So we're going to be essentially doing the same thing. So we factor in the gross income from operations. Right, we're just going to make this wrap text. We can make it a little smaller. All right, perfect. All right, so in this case, we start to look at the income from the operations to calculate. So we have gross income from operations of $660,000. There's dividends, as we see here, of $240,000. And then from there, we subtract the expenses. It lets us know that the expenses are $760,000. So our income before the dividends received deduction is as follows: 660,000 plus 240,000 less 760,000 gives us income before dividends received deduction of $140,000. So for scenario A, it says assume they own 12%. Because this is less than 20%, then we are limited to 50%. So therefore, we factor in the taxable income, and we'll actually just, put it to the side. right? We'll put it to the side because again, step one, we calculate the dividends received deduction. We multiply the dividends received by the percentage. And the next step is to compare it all right. The next step is to compare it to the income before the dividends received deduction. So 140,000 multiplied by 50%. So if we compare the two, we see that the lesser of the two is 70,000. But again, we have to account for the fact that if we take this full amount from step one, is it going to result in a net operating loss? So 140,000 minus 120,000, there would still be taxable income of 120. So therefore, that exception does not apply. So therefore, we claim dividends received deduction of 70,000. So Swallows taxable income after deducting dividends received deduction is 140,000 minus 70,000. It would be 70,000. So now for scenario B, it says assume that instead Swallow Corporation owns 26% of the corporation stock. So we already know this information. We can essentially just, copy it over. So we know the total amount of dividends, but instead of it being 50%, it's 65%. So 240,000 multiplied by 65% is 156,000. And then the taxable income before the dividends received deduction is 91,000. So when we compare the two, we see that the $91,000 is the lesser of the two. But again, we want to determine if we deduct the amount from step one, which is 150,000 from 140,000, will it create a net operating loss? So in this case, it will. 140,000 minus 150,000 would give us a net operating loss of 16,000. So therefore, Swallow's net operating loss after deducting the dividends received deduction is $16,000. So again, the key thing, as we saw in the previous example, these are the steps. Multiply the dividends received by the deduction percentage based on ownership. Multiply the taxable income by the deduction percentage. And then from there, the deduction is limited to the lesser of step one or step two, unless deducting the amount derived in step one results in a net operating loss. All right, so this brings us to our next problem. So here it asks how much of the capital loss may be deducted for the year and how much is carried back or forward if GoShock is a proprietorship or B, a C corporation. So it states Virginia owns 100% of GoShock Company. In the current year, GoShock Company sells a capital asset held for 3 years at a loss of $40,000. In addition, GoShock has a short-term capital gain of $18,000 and net operating income of $90,000 during the year. Virginia has no recognized capital gain or loss before considering her ownership in GoShock. So, A, if GoShock is a proprietorship, how much will be considered deductible, right? So, in this case, for corporations rather, corporations are allowed to, take deductions, but again, there's a limitation. So for taxpayers, on the other hand, a taxpayer's short-term gains and losses are combined and long-term gains and losses are combined. And then from there, this results in a net short-term capital gain or loss and a net long-term capital gain or loss. And if gains and losses result, then, it's further netted together. So in this example, we see All right. So net capital losses for the corporate and individual taxpayers, again, as we know, they receive different treatment. So for the most part, individuals, they are allowed to claim a maximum capital loss of $3,000 each year against other income. And then, any other losses, they are carried forward. But if Ghost Shark is a proprietorship, only $21,000 of the $40,000 long-term capital loss is going to be deducted in the current year. All right. So how do we determine that amount? $40,000 here lets us know that we have a loss. Oh, sorry about that. All right. So we have the short-term capital gain of 18,000, and then we have the capital asset with the loss of $40,000. So 40,000 minus the 18. So essentially, the loss is basically going to offset the long-term capital gain. And then essentially what happens is that the remaining amount is going to be carried forward to the next year. So since they're the proprietorship for the long-term capital loss, the amount that is allowed to be deducted in the current year is $21,000. And then the remaining amount is carried forward. So the remaining $19,000 is going to be carried forward. And then it retains its character as long-term, because again, if we net the two, we have the short-term capital gain, and then from there we had the long-term capital loss. Now for B, it says, if Ghost Shark is a C corporation, how would we account for it? So in such case, if Ghost Shark was a C corporation, $18,000 of the long-term capital loss would be deducted. How do we know that? We know that because $18,000 represents the capital gain, and we know that capital gains for corporations are limited to the extent of the capital gain. So losses are limited based on the capital gains. And then from there, the remaining $22,000 is carried back and then forward, and it's treated as a short-term capital loss. All right. So just something important to keep in mind, again, as you are dealing with the differences between corporations and individuals. All right. So again, the key thing is that you need to be able to account for it. So with this 21,000, again, the key thing is that we account for the $18,000, right? Which is able to offset the amount. So the $18,000, and then from there, we account for the $3,000 maximum loss that is able to be claimed. So that is how we calculate the 21,000. So again, we have the loss of $40,000, and then we have a short-term capital gain of 18,000. So it's a bit, similar to the corporation. We get to claim an $18,000 loss, and then we account for the maximum capital loss of 3,000. So the 21,000 is going to be the long-term capital loss that's deducted in the current year. And then the $19,000 loss is what is carried forward and retains its character as long-term, versus the C corporation, whereby the C corporation can only deduct the long-term capital loss to the extent of its capital gain. So just a very important distinction between the individual and the corporation. The individual can claim to the extent of the capital gain plus the maximum $3,000 that's allowed to be deducted. For individuals, the losses are carried forward and retains its character as long-term. For corporations, the net loss is carried back 2 years and then forward 3 years, and then it's treated as a short-term capital loss. All right, so this brings us to our next question. And here it asks, determine how much of the 2024 salaries for Marcia and Zach is deductible by broad bill in 2024 if the corporation is A, a cash method taxpayer, and B, an accrual method taxpayer. So it says broad bill corporation, a calendar year C corporation, has two unrelated cash method shareholders. Marcia owns 51% of the stock and Zach owns the remaining 49%. Each shareholder is employed by the corporation at an annual salary of $240,000. During 2024, Broadbill paid each shareholder employee $220,000, with the remaining $20,000 paid in January of 2025. So, as a general rule, the cash method of accounting, it's unavailable to corporations. However, there are some important exceptions, right? Based on different types of corporations. And whenever there's a corporation that uses the accrual method, there's, special rule when it comes to dealing with cash basis parties, pretty much. So for this example, if they are a cash method taxpayer, they want to know how much can we deduct. So under the cash method of accounting, the salaries are deductible in the year in which they are paid. So in such case, here we see that they paid each shareholder employee $220,000. So we multiply it by 2. Under the cash method, they can deduct $440,000. So again, that's one of the key differences between the cash basis and the accrual basis. Cash basis, you record expenses when they are paid, and you record income when it is received. Under the accrual basis, it does not matter when the income is received. The key thing is, was the income earned? And for expenses, the key thing is, was the expense incurred? So in this example, we see that during the year, Broadbill paid each shareholder employer $220,000, with the remainder paid in January of 2025. But the key thing is, doesn't matter, right? The shareholders worked for the corporation, and so because they work for the corporation, the key thing is, we need to account for the amount that was paid, which is $440,000. And then we also account for the accrued portion of Marcia's salary, which is $20,000. So therefore, under the accrual basis method, we recognize the $460,000. So something very important to keep in mind, again, that's the difference between the cash basis and the accrual. Cash basis, you only record income and expenses when they are paid. Under the accrual basis, income is reported when it is earned and expenses when incurred. All right, so this brings us to our last question. So it asks us to compute the charitable contribution deduction, ignoring the percentage limitation for each of the following C corporations. So it states that Amber Corporation donated inventory of clothing. There was a basis of $24,000 and a fair market value of $30,000 to a qualified charitable organization. So both corporations and individual taxpayers, they are allowed to deduct charitable contributions if it's a qualified charitable organization. So generally, a charitable contribution of property, that essentially would result in a deduction that's equal to the property's fair market value as of the date of the gift. So basically, as a result of the rule, if there's a contribution of a lost property, that's basically when the fair market value is less than the basis, then, it should be avoided essentially, right? Because the loss is not going to be recognized. But as a general rule, the deduction for a corporation of ordinary income property is limited to the basis of the property. So for certain contributions of inventory by contributions, however, the deduction is essentially equal to the lesser of the sum of the property's basis plus 50% of the appreciation on the property, or twice the property's basis, right? So based on this information, this is how we would calculate it. And again, they donated inventory. So the first scenario would be 24,000, which represents the basis. And then from there, we would add 50% of the appreciation. So the appreciation is 30,000 minus 24,000, which is 6,000. We multiply it by 50%. So we would add this amount to the 24,000, and that would give us a basis of 50,000. So we essentially claim the lesser of the two. In this case, it will be 27,000, which is the property's basis plus 50% of the appreciation, or twice the property's basis. The basis is 24,000. We multiply it by 2. So if we compare 48,000 to 27,000, we know that 27,000 is the lesser of the two. For B, it says Brass Corporation donated stock held as an investment to Western College, a qualified organization. Brass acquired the stock 3 years ago for $18,000, and the fair market value on the date of the contribution is $32,000. Western College plans on selling the stock. So the fair market value is essentially, as mentioned, the valuation amount for most charitable contributions when there's capital gain property. So capital gain property is property that, if sold, it'll essentially result in a long-term gain, or what's called Section 1231 gain for the taxpayer. But there's two situations. A capital gain property, when there's a charitable contribution, is measured by the basis of the property rather than the fair market value. So if the corporation contributes tangible personal property, and let's say the charitable organization puts the property to an unrelated use, then the deduction is limited to the basis of the property. So Brass Corporation is contributing capital gain property, thus the deduction amount is the property's fair market value. Stock is basically considered intangible personal property, so therefore the qualified organization's use of the stock, however they want to use it, really doesn't matter. So therefore, in this example, they reported as 32,000. All right, this brings us to the last question. So, all right, Ruby Corporation donates a sculpture held as an investment worth $130,000 to a local museum, which exhibits the sculpture. Ruby acquired the sculpture 4 years ago for $55,000. As we just pointed out, fair market value is the valuation amount for most contributions of capital gain property. So capital gain property, it's property that is sold. It would report in long-term capital gain, or Section 1231 gain for the taxpayer. So if the corporation contributes tangible personal property and the organization puts it to, unrelated use, then it's limited to the basis of the property. But Ruby Corporation, as we see here, they contributed capital gain property. So the deduction amount is the property's fair market property. And then because it's a tangible personal property, so the key difference between B and C is that B, stock, is intangible. You can't touch, see, feel it. You cannot perceive it with the 5 senses. But for C, they're donating a sculpture. We can touch the sculpture. We can see the sculpture, right? So the property is tangible property, and it is put to use for a related qualified organization's exemption function. So therefore, they get to claim the fair market value. All right. So this brings us to the end of the questions for chapter 3, which covers corporations, introduction, and operating rules. So we covered a lot in this chapter. There was some comparison of corporation and individual tax treatment as it relates to capital losses. We also discussed some of the filing requirements. We also discussed essentially charitable contributions, net operating losses, and calculating the dividends received deduction. So there's a lot to consider, when you're dealing with corporations. But again, as you continue to work in the profession, you will continue to learn and grow as a tax accountant.